In this episode, we will look at variable and absorption costing compared to one another when production equals sales. In order to see how variable costing and absorption costing impact the amount of income reported, we're going to use the following cost information. This particular example, we're going to assume that the company incurs direct material cost per unit of $4, direct labor cost of $8 per unit. In total, variable overhead is $180,000, fixed overhead is $600,000, total overhead is $780,000. Management expects to produce 60,000 units each year. In order to look at the difference between variable and absorption costing, we first need to calculate the cost per unit under both of those methods. Recall that under absorption costing, the product cost is going to be all costs incurred: direct materials, direct labor, variable overhead, and fixed overhead. The variable costing is only going to be the direct materials, the direct labor, and the variable overhead, only the variable cost. Fixed overhead is not included as part of the cost of goods sold under variable costing. In order to calculate the per unit cost for our overhead, we needed to take the total amount of overhead and divide by the number of units. So total variable overhead of 180 divided by expected production of 60,000 is how we come up with the $3 per unit. We do the same thing for fixed overhead. 600,000 divided by 60,000 units to get fixed overhead of $10 per unit. We are now able to calculate variable and absorption costing product cost. So here it is summarized. We're going to assume this year that the number of units produced equals the number of units sold. That means that the company had no units of product left in inventory, a zero ending inventory. Looking at the income statement that would be reported externally, total sales would be 60,000 units times the unit selling price of $40, $2.4 million. Cost of goods sold under absorption costing. Recall that under absorption costing, the product cost includes all costs, both variable and fixed. So the cost of goods sold product cost will be $25 per unit, leaving us with a gross margin of $900,000. Then we would subtract out our selling and administrative expenses, the fixed of $200,000 plus the variable of 60,000 units at $2 per unit, giving us net income of $580,000. If we were to prepare an income statement for this same year under variable costing, looking at the income statement under variable costing, we would see that total revenues would remain the same, number of units times the same selling price. We would then subtract our variable cost, 60,000 units times a variable production cost of $15 per unit, because recall that under variable costing, the unit cost only includes the variable. Then we would subtract out the variable selling and admin to get total variable cost of $1,020,000, contribution margin of $1,380,000. We would then subtract out our fixed cost. Our fixed overhead, which you recall was $600,000, and our fixed selling and admin, resulting in a net income of $580,000. The net income under both variable costing and absorption costing is the same, because the number of units produced equals the number of units sold. That means that all costs of production are expensed in that year under both methods.